Hey guys, our team is Flash and this teacher is about trading volatility with options. So let me first give you some background knowledge of our study. The options are financial instruments that give the holder the right but not the obligation to buy or sell underlying asset at a specific price on or before a specified date. So there are two types of options which are calls and puts. So some of the key parameters related to options include volatility, the underlying asset price, the strike price, the risk-free rate, and the time to maturity. There are different types of option pricing models. One of the most famous one is the Black-Scholes model. So in this model, it's usually used for European option pricing, and it divides the value of the option into two parts, which are intrinsic value and the time value. So from the Black-Scholes model, we can tell that when the volatility is higher, the price of the option is higher, and also the longer term of the option have a higher value than the short term. And for the binomial model, it can be used for pricing both the European and the American options. And for the Monte Carlo simulation, it can be used to simulate price paths to predict the option value. So volatility trading is often used with options. The historical volatility, which also referred to realized volatility, is the actual volatility that is past data. And the implied volatility reflects the market expectations with future price movement for an asset. So the implied volatility can be calculated using Black-Scholes model. By backward the Black-Scholes model, by giving the option price, we can calculate the implied volatility. And there are also several types of volatility trading strategies. One of them could be the straddle as rental, and it could also be via as options. So instead of like only hedge and speculate on one individual asset, in this case, we're able to predict and bet on the overall market volatility. So here's a graph of the VIX index. So these kind of high spikes shows that pretty severe financial crisis, and it has a pretty high volatility. So we could also use the volatility arbitrage by taking the relationship between implied volatility and also the realized volatility. We're able to buy low and sell high in order to make a profit on arbitrage. So delta hedging is also a very effective risk management strategy. We're able to keep us in a neutral position that avoid from the change and the movement in the price of the underlying asset. So this graph shows an example of the delta. In this case, the short color has a delta of negative 0.55. So it means that it profits $0.55 for each dollar decrease in the underlying asset price. Since the standardized option size of option is 100, so in this case the delta is minus 55. So obviously you want a positive 55 delta to hedge it. So one way to do it is just buy 55 shares of stocks. So in this way, we're able to delta hedge the position. But it's worth noting that it's only at this specific price the delta is there. If the price moves up or down, the delta will change. So it is important for us to remember always dynamically hedging it to avoid a directional risk. So our strategy is mainly about delta hedging, implied volatility, and also the realized volatility. So now I'll hand over to them to talk more about the.
Thank you. Now let's take a look at our trading strategy. First, we observe that the difference between the implied and the actual volatility tend to be zero reversed. That is, the gap between the blue and the orange line tend to become zero each time when they have a spread. And we can potentially make benefit from it. And we also verify this by using ADF test for specific ETFs. And since we are trading volatility, we need to be delta neutral. And our strategy is that if we believe the volatility should be higher, we run the option and do delta hedging with the stocks. And if we believe the volatility should be lower, we do the opposite. And by doing so, we can potentially take benefit from the differences between the implied and the actual volatility. And we take our ideas into coding. And our first version performed bad. we actually take several stocks to do so. And we have, after diving deep into our first version, we can systematically losing money. We have two most important insights. The first one is that trading on several stocks or even one single stock is super risky. And the second one is that bid-ask spread is super important, since we lose money if the bid-ask spread is very large. And a natural solution to the first challenge is that we just pick many stocks for each sector and build a portfolio contains of like 50 or 60 of stocks. However, there's a limit for the rank. So we have constraints on Quant Connect. And if we have to select very few number of stocks, ETF can be a better solution. And to encounter the second problem, that is the bid-ask spread problem, we do sorting. That is for different candidates from different sectors, we sort by the historical bid-ask spread, and we select the two smallest ETFs to trade. And we also want to capture the market sentiment. For doing so, we construct an NLP process. That is, we first do tokenization and lemmatization to convert words into tokens and in uniform form, and also consider the context. And we use the sentiment model built in NLTK using weighted algorithm. And after doing so, we construct a sentiment score model. We want to do so is because we believe the impact of the news may not only last for 1 hour. For example, if we only consider the current time, super negative news may continue to influence the company's stock when the time goes by. So in our project, the lambda is 0.5. That is, we make sure the most recent news plays very important part in our score, and the old news play very least part, but they all have some contribution to our final score. Based on those components, we will construct our signal. We first construct the distribution for the difference between the implied and the actual volatility. And for each ETF, we have 3 different distributions for bullish, bearish, and neutral markets. And it's also dynamic distribution. Namely, we will update hourly to append the new data and deprecate the old data to construct the historical difference distribution. And for the given time, the input will be the current difference, the current sentiment, and with the corresponding distribution, our signal can be the standard deviation for that single data point. To make our strategy profitable, we also have several models. First, our answer condition is that our signal is above or below certain threshold. The 2 numbers are different is because our distribution is skewed. It's not symmetric. And also, we have our dynamic allocation function. That is, we want to buy more if the signal is strong and buy less if the signal is weak. And we also use log to capture it to prevent it from exploding to like infinity. And we also want to set a good spot between like making profits and accuracy and transaction costs. That is, we trade hourly and delta hedging every day. It's very challenging due to Quant Connect since the option data only have minute solution on Quant Connect. So we have to do some engineering work. And we also have a rollover mechanism. That is, if a contract will be expired in 5 days, and if our signal is strong enough, we still have signal, we will roll over to the next contract with the same strike price. And since, as I mentioned, bid-ask spread is very important, we also have another layer of safety check. That is, we only trade the contract whose bid-ask spread is smaller than 0.5. And we also baked in slippage volume-based slippage model and interactive broker fee model. Finally, we will exit our position if we earn by a certain percentage profit taking or stop loss, or if the option expires. And we will liquidate both the option and the corresponding stocks at the same time. As I mentioned, our risk management strategies were baked into every corner of our whole strategy. As I mentioned, for exiting, we have profit taking, stop loss, and we do diversification by selecting ETFs from different sectors, and we have different distributions for different market sentiments. We have bid-ask spread sorting and constraint, and we have dynamic allocation to prevent you bet a lot when the signal is weak. And besides those, we also build a mechanism when we approach the margin limit, we will increase our position by 10%. Let me hand over to Tego to introduce our results.
Okay, so in these sections, we are going to look at some numbers. Okay, this is basically our summary of our backtesting. Later, we'll introduce each period one by one. And regarding the trading ETFs, key principles like Nancy just mentioned, we only trade the first two ETF that has the smallest bid-ask spread. That is very important for our option trading. And in the Sharpe ratio, we can see that most of the periods, the Sharpe ratio performs well. However, in the return, in the in-sample and stress testing, the return is good. But however, in the other three samples, sample period, it is not. Okay, so besides these numbers, although they are important, but what's more to us is that we want to review is if our strategy work as we expected, what does it do well, and what needs to be further improved. Okay, so at the beginning, we want to emphasize that we are not trading volatility. We are trading the volatility spread, which is the difference between the implied volatility and actual volatility. So with that in mind, we'll first look at the in-sample and the stress testing period because they have overlap in the March 2020. And as you can see on the left, most of our return, our profit contribute from this period. This is a 5-month period from November 2019 to March 2020. And in the beginning of the first 4 months, our strategy thinks that the volatility is overestimated. So we shorting options and hedging with stocks to profit. And when March 2020, the pandemic is born, our model thinks that the volatility is underestimated. So we reverse and long in the options. And it turns out that give us the best profit, which is the bar here, which is the largest. When we dive deep into this March 2020, and we can see the same that in the entire month, our strategy have been maintaining the long option position in the entire month. So that is why we believe that it has an impressive Sharpe ratio. And the second, we'll look at the out of sample one. And in this period, the market is considered volatile. But again, we are not trading volatility. So it means that at this certain period, which is the main returns come from, we are actually shorting options because we believe that the volatility here is overestimated. So our strategy is shorting options and it works in the internal to having benefits. So it means that our strategy doesn't rely on long in options alone. We can do it either way. And that's what we do good. Now we are going to look at what we can further enhance. Okay, so in this case, the out of sample two, the market is considered volatile, especially in the week of June 20. But it suddenly recovered in the next week. And in this case, our strategy still did good because it maintains our shorting option position in the week of June 27, which profit. However, there's a mistake that our strategy made. In the first quarter of 2016, that our strategy thinks that the volatility is underestimated. So it keep longing the options and it keep making mistakes till almost the end of that quarter. You realize that the volatility will not increase. So it turns out to reduce the loss by shorting the options. But the damage has caused, which reflect in the Sharpe ratio. And furthermore, in the blind out of sample period, although the result is good, but we also figure out that there's further things we can improve. This is considered a volatile market, especially in February month. And it is mostly because of inflation. And our algorithm thinks that the volatility is overestimated, so we short. And the result turns out to that shorting options is a good decision. However, our data hedge strategy seems to have a delay of 1 day here. So you can see even we are shorting the options at the first day of the month because the data hedge has not yet effective. So we lost on the first day. So we can
say that again? You mean you had option positions, but you don't have the delta hedge on?
we hedge the other day. We doesn't hedge on the same day.
You mean that's the nature of a strategy? You don't put on options and stock on the same day? Okay,
So it's not exactly at the same time. For short options, we hedge once per day to avoid shorting too frequently and lose money. So we probably put on a short option, let's say in the morning, and then we only shorted hedge in the afternoon, and we lost money during that time period probably.
okay. So the point is that if you put a trade on the same time, you could avoid it. That's an easy fix.
Right.
So, but once the trade is put on the same day, you can still hedge it, adjust the hedge every day.
Yes, that's what we do for
Yeah,
our
okay.
option.
But I think the only thing, small change would be just put the trades on, open that same day, same time. Yeah.
Yes, we found that it's much easier said than done. Like we're doing this right now because it's the most reliable way to make sure we're constantly hedging.
Okay, gotcha. Thank you.
Okay. And so basically that's another thing that we can improve. So with that in mind, and also I mentioned in the very beginning, the return was not always satisfying in every period. This has become our motivations to further improve on this project, which Robert will introduce our future work plan with you.
Right. So now on to limitations and future work. What are some limitations of our current implementation? On one hand, you have those due to Blunt Connect, like the two previous teams talked about. The data is probably not of the highest quality or the most timely in Blunt Connect. And we are limited to using the NLTK package and models within to model sentiment, which is probably not the best tool to do the job. Specifically for us, we saw that in some of our back tests. Sometimes Blunt Connect would tell us that it couldn't find market data for a specific trade. And so it resorted to using trade bar data to fill the backtest, which means that the performance of the backtest might not be the most faithful representation if we were to put the strategy into a live trading environment. And then on the side of our strategy, we proved empirically that the implied volatility and realized volatility are co-integrated and the spread is stationary, but we don't have a very good understanding of the average size of that spread. We're currently modeling that size with sentiment, like we talked about earlier, but there could be better ways to do it. And also, when it comes to risk management and portfolio optimization, our current implementations are a bit rigid still, and more flexible ways could perhaps allow us to enter more winning trades more frequently. So which brings us to some areas we want to focus on. We are interested in bringing in additional data feeds and also to see if there are ways to bring in additional NLP models to improve our sentiment scores. We want to get a better understanding of the dynamics of the implied realized volatility spread. And also, there are some other ways we can control this. For example, right now, our positions are delta neutral, but not gamma neutral. And also, we don't have a particular way to react to when the market regime changes, and we're still holding large positions of that we entered into in the previous market week. But before we finish up, I want to talk about one more thing. So, like Taylor talked about, we our strategy has a pretty good Sharpe ratio in our in-sample training period and most of our testing periods. But whatever we tried, we weren't able to get good returns. Returns were pretty humble, to say the best. And that made us feel like something was probably off. So last night, we had a lengthy discussion to ultimately answer this. Is our return strategy trading the spread, or is it trading the realized volatility, the RHI? And we think that it is probably still very much exposed to the ups and downs of realized volatility, which is why during the pandemic, we made a lot of money, right? But our original goal was to trade the spread. So we thought one way to do it is to introduce another instrument that's only tied to implied volatility. And what we thought of last night is to introduce straddles. So essentially, if we enter a short position like we do now, we'll enter a long straddle and vice versa. And we also coded up a bare bones proof of concept algo to do that. This doesn't have a lot of the risk management, asset allocation modules we built for our primary strategy. And also, we're only trading SPY here, so there's no diversification. But you can see that return for the in-sample period, the 4 years, is 80%. And this made us confident that if we were to introduce the risk management, asset allocation, and all the other bells and whistles we have in our other strategy, we could further improve returns and also improve the Sharpe ratio. And it made us confident that we are on the right track. And if we had more time, this is probably the strategy for us.
Good.
Questions? Yeah.
I want to ask more about that one day in February where you lost money first. Why do you think that your strategy was late, considering you are using sentiment analysis and this inflation topic and also the tech layoffs were going on well within a month before that date?
Yeah, so we have a 90-day look back period, right? So it's probably won't act right away when something changes, or even when the market changes, right? Sometimes it might take a few days before the algo realizes things have changed and it should start generating new signals. Yeah.
So how do you decide how many options you're buying or selling at each time?
Good question. So yeah, we have it here. Yeah, so we have a base number of options that we want to buy, probably 100 contracts. From currently at 300. And then we multiply that with this multiplier here, which essentially is a regulating function of the signal over the threshold, which is 1.6 or negative, right, depending on which direction.
300.
So,
options,
right.
Which do you compare it with like the budget that like, so with options, like the notional value of the option is much higher than the actual price of the option. So you could think, let's say if you're holding 300 options that cost like $2, but then they might be controlling like 300,000, I'm not 300,000, like $3,000 of this underlying.
Right.
So what the reason I was asking is like one of the reasons our returns were low when we were working on this options-based project was that we were buying too few options.
Yeah.
And when you increase that number, your returns increase. So even though your Sharpe ratio is good, your returns are low, that might indicate that you're just not buying enough options.
Yeah, that's a very good point. And we also tried that. But one thing to note is if we're hedging as well, right? So for every one contract we enter, we have to essentially buy around 50 shares, right? So that takes up a lot of capital. And we tried further increasing the base number of options we're buying, and it resulted in us not having enough capital to enter into a lot of positions.
You mean, when you say not enough capital, you encounter margin calls?
Not necessarily margin calls, they just tell us that you don't have margin to enter into the position at all.
Interesting,
You
yeah,
just run out of margin, basically. But
yeah,
you're buying-
well, it's, yeah, that depends how the model would work, right? You would think on a delta hedge basis, right? The leverage could be
Yeah.
could be significantly higher. So unless you're running, yeah, because this is something you can consider later. I think Renee's point you need to consider is because if you leverage up your portfolio appropriately, let's say 2 or 3 times, right? So if you have that capacity, your return would be
Right.
2 or 3 times, right? So the point of trading options in that way is because allow you to gain leverage. So whether or not, so you're given $10 million, that's capital, but you can do multiple times in terms of notional value. Something to think about.
So one more thing is, so if you're long the option, so then you're delta hedging by shorting the stock. There you have 100% limit of, so if you have $1 million, you can only short $1 million worth of the underlying. But if you're shorting the option and then you're long the stock,
They
then
cancel each other out.
you can buy more than $1 million. You can long more than $1 million of the stock. So that's just how margin requirements work.
Yeah, we'll probably take another look into
Yeah.
our market model.
Yeah, so, but, good. Any other questions? Go ahead.
Are there any intuitions behind this function here?
This function?
Uh-huh.
No, we initially wanted something to regulate this signal versus threshold value because, so we first wanted to, double down on, signals that are very large, right? Because they're most likely your winning strategy. But then if you just use the raw number here, sometimes the signal could be 10. Right, and then like, we didn't enter into a very large position, which we don't want. So this is just to regulate this value.
Using the log to regulate that, to avoid immediate disposal.
At first, we tried different combinations like polynomial, things like that, but it can be exploded when the signal is very large. So we use log to regulate this and also like we want when the signal is exactly the threshold, that is when this equals to 1, the multiplier is 1. Yeah.
All right. If there's no other questions, great, thank you very much.